Bismillahirrahmanirrahim. Hello everyone, welcome back to the another video. Today in this video, we are going to start very interesting chapter of the partnership, which is admission of a partner. In previous video, we have already finished the chapter, which was change in profit sharing ratio. Admission of a partner is very important in the partnership chapter because from this chapter, in board examination, many of the questions arises. Let us see here. First of all, we will understand the concept of admission of a partner. Admission of a partner, it means a new partner will enter into your partnership business. Suppose A and B are partner in a business. Now the new partner wants to take admission, which is C. What will be the procedure of the admission? According to the Indian Partnership Act 1932, section number 31 defined about the admission of a new partnership. What it defines? It defines that if it is so agreed in the partnership deed. It means if it is mentioned in the partnership deed, then you can take the admission of a new partner. And the second point is that if it is not mentioned in the partnership deed, but all the partners are agreed to take the admission of the new partner. So here are two conditions that has been defined under the Partnership Act 1932. First one, if it is mentioned in the partnership deed. If it is not mentioned in the partnership deed, then if all the partners are agree to admit the new partner. So these are the conditions of admission of a new partner. Now what would be happen at the time of admission of new partner? At the time of admission of a new partner, the reconstitution of a firm will be happen because old partnership agreement, old partnership deed comes to end and a new agreement among all the partner comes into force. This will be the impact of the partnership deed. Now, if you take the admission of a new partner, then what type of rights you will have to give to the new partner? The rights here given two types of rights. First, right to share future profits of the firm, profits and losses both. If after the admission, if business get any type of liabilities, then the new partner will also be liable to pay this liability. Next right to share assets of the firm. If there is any asset in the partnership firm, then they will also get the right of to share of this asset. So these two types of rights they will get. And at the time of admission of a new partner, what would be happen? Suppose here two partners A and B, their profit sharing ratio is 3:2, like this. Now you are taking admission of a new partner, which is C. What would be happen here? Suppose C is admitting into your business 1/3 share of profit, then your profit sharing ratio, it means the profit sharing ratio of A and B will be minimized. Here, the A and B will have to sacrifice their profit share on behalf of C. So, in this situation, new partner compensate all partners who sacrifices their shares in his or her favor. The new partner pay for their amount of sacrifice in the form of goodwill, and this goodwill is also known as premium for goodwill. In short, we can say that when we are taking admission of any new partner, then at the time of admission, the old partners are sacrificing their shares. For compensating these sacrificed value, the new partner will bring amount of goodwill, which is known as the premium for goodwill. So the admission of a new partner, what types of accounting adjustments is required? See here. First one is change in profit sharing ratio. Their profit sharing ratio will be changed, and we need to determine the new profit sharing ratio as well as sacrificing ratio. Next, accounting adjustment will be here, valuation of goodwill or accounting treatment of goodwill. Third, adjustment of gain or loss from the revaluation of assets and reassessment of liabilities. And fourth, adjustment of deferred revenue expenditure or advertisement suspense. And fifth, adjustment of reserves, accumulated profits or losses. At last, we have to learn adjustment of capital on the basis of new profit sharing ratio. These are the accounting treatments that we have to do after the admission of a new partner. You see here, first of all, we will start from the topic 1, which is change in profit sharing ratio or determination of new profit sharing ratio and sacrificing ratio. This is our first topic of this chapter, and this topic is too much important for board examination point of view as well as competitive examination point of view. Okay, see here, in this topic we will have multiple types of cases, and each case we will understand with the help of an example. This is the case 1, when profit sharing ratio of new partner is given but sacrificed share of the old partner is not given. In this situation, what would be happen? How you will calculate the new profit sharing ratio and sacrificing ratio? We have an example. Suppose A and B are partner. A and B are partner. Their profit sharing ratio is 5:3. Here is a new partner C who is taking admission for 1 by 4th share. Then you have to calculate the new profit sharing ratio and sacrificing ratio. What you will do? First of all, we will have to assume that let total share is equal to 1. If in question it is not mentioned that how old partner will sacrifice their share. In this way, we have to assume that the total share of the firm is 1. C is taking how much? 1 by 4th of the total share she will take. Then how much will be the remaining share? Your remaining share will be here 1 minus 1 by 4th. It means 3 by 4th will be the remaining share. And this 3 by 4th share will be distributed to A and B in their old ratio. So we will calculate the new share of A, 3 by 4th of 5 by 8, 15 by 32. For B, 3 by 4th of 3 by 8, 9 by 32. And for C, how much the C share is here? 1 by 4. We have to equal the denominator of all the partners. After that, we can write it into the ratio form. We have to multiply here from 8 upon 32. Now the new share profit sharing ratio will be 15:9:8. This is your new profit sharing ratio. After the calculation of new profit sharing ratio, you have to calculate the sacrificing ratio. What is the formula of sacrificing ratio? Sacrificing ratio of A, old ratio minus new ratio. What is the old ratio? 5 upon 8 minus what is the new ratio? 15 upon 32. 32, 20 minus 15. It means 5 upon 32. And for B, 3 upon 8 minus 9 upon 32. 32, 3, 8 for the 32, 3 for the 12 minus 9, 3 upon 32. It means 5 upon 3 will be their sacrificing ratio. Here is a trick that if in question it is mentioned that you have to calculate the sacrificing ratio and the question is objective, then remember the point that your old ratio will be the sacrificing ratio. In this case only, where the old partner's sacrificed share is not given. In this case only, not any other case. Your old ratio will be your sacrificing ratio. In next video, we will learn more cases.